Hi there, and welcome to This Explainer. I'm Michelle. If you've owned your home for decades, wow, congratulations. That is a massive achievement. But, as you start considering your next chapter, maybe downsizing, moving to a senior living community, or just getting closer to family, you're probably facing some heavy financial questions. Today, we're creating a completely pressure-free space to navigate the realities of selling. Specifically, we're going to focus on capital gain strategies for homeowners over 50. Let's just go ahead and address the biggest worry in the room right away. Will taxes consume your profit? It's a question that stops so many homeowners dead in their tracks. And listen, it is completely normal to feel a bit overwhelmed or even anxious that selling your longtime home means losing a massive chunk of your hard-earned equity to the IRS. You've built that wealth over decades and you want to protect it for your retirement. Well, take a deep breath. I'm here to tell you that for most folks, the tax impact is actually far smaller than you might expect. So let's dive into this by clearly defining what we're actually talking about. What exactly is a capital gain? Simply put, it's the profit you make when you sell something for more than you originally paid for it. For example, say you bought your home 30 years ago for $180,000, and today you sell it for $480,000. That difference, that $300,000, is your capital gain. Now, the IRS may want a portion of that profit, but the absolute keyword here is may. And this is exactly why we don't need to panic. It's all because of something called the primary residence exclusion. You can think of this as a sort of magic shield for your home equity. It's an incredibly powerful tax relief tool designed specifically for homeowners. For so many folks over 50 who've lived in their family home for a good long while, this exclusion can often entirely protect the gain from federal capital gains taxes. It's really a game changer. Okay, so what are the actual numbers? According to current IRS rules, if you're a single filer, you can exclude up to $250,000 of your profit from federal capital gains tax. Just let that sink in for a moment. That means if your profit is $250,000 or less, it completely falls within this exclusion. You would owe absolutely zero federal capital gains tax on that amount. None. And if you're married and filing jointly, the news gets even better. You can exclude up to $500,000 of your profit. For so many longtime homeowners, this $500,000 exclusion means the entire gain from selling a family home is completely shielded from federal taxes. That is a massive amount of your wealth, safely preserved for whatever comes next. Now, you might be wondering, what's the catch? Well, the IRS makes qualifying for this surprisingly straightforward with two primary tests you need to meet before the sale date. First up is the ownership test. You must have owned the home for at least 2 years during the 5-year period right before you sell. Second is the use test. You must have lived in the home as your primary residence for at least 2 of those exact same 5 years. If you meet both of those requirements, you're in a really fantastic position. Actually, I want to pause here for a quick second to clear up a very common misconception. You might remember hearing about a special one-time tax break specifically for sellers over age 55. Let's bust that myth right now. That old over 55 rule was actually repealed way back in 1997. It was replaced with the current exclusion system we just talked about. And the best part, today's system is much more generous and it's available to you at any age. So you don't have to wait around to hit a certain birthday to make a move that's right for you. Of course, federal taxes are just one piece of the puzzle. What about state taxes? Well, looking at Illinois as our example today, the incredibly reassuring news is that state rules directly follow the federal primary residence exclusions. This means any gain you successfully exclude at the federal level is automatically excluded from your Illinois taxable income too. It really simplifies things. But let's say your home has appreciated so beautifully that your profit actually does exceed those generous limits of $250,000 or $500,000. Please don't worry. The remaining amount above the limit simply becomes taxable. And in Illinois, it's taxed at a straightforward flat income tax rate of 4.95%. That rate applies to everyone in the state, regardless of your income bracket, which makes the math relatively clean once you have your final numbers in hand. So here's a crucial point. If you think you might exceed the exclusion, you have another wonderful tool at your disposal. Home improvements actually increase your cost basis. Now, your cost basis is just the base figure used to calculate your gain. The higher your basis, the lower your taxable gain. Think of all those major renovations, additions, and upgrades you've done over the years. Those aren't just fond memories of a kitchen remodel, they're valuable receipts that can actively lower your potential tax burden. All right, so how do we turn all this knowledge into an action plan? Before you sit down with a professional, gathering your paperwork is key. Here are 4 simple things to track down. Number 1, your original purchase price and closing documents. Number 2, those records of major home improvements we just discussed. Number 3, note any previous home sale exclusion claims you might have made in the past. And number 4, have your current mortgage payoff amount handy if you still have one. Just having these 4 things ready will make your conversation with an advisor incredibly productive. Who knows, you might even uncover deductions you didn't know you had. And speaking of professionals, this explainer is here to give you a great foundation, but you absolutely shouldn't do this alone. You really need a trusted support team. A CPA or tax advisor with real estate experience is your perfect starting point to run the exact math. Next, a financial advisor can help you see how the sale proceeds fit into your beautifully planned retirement picture. And finally, an SRES, that's a seniors real estate specialist, can walk alongside you, coordinate with these professionals, and gently guide you through the real estate strategy, totally pressure-free. Capital gains tax can sound super intimidating at first, but the primary residence exclusion means the financial impact is usually far smaller than you might fear. The key is simply getting informed before you make any decisions. As the saying goes, knowledge is the starting point, and you're already here. So take your time, lean on your trusted professionals, and gather your facts. With your hard-earned equity protected, what does your next beautiful chapter look like?